If you've been watching the stock market recently, you might feel like you're on a roller coaster. The ups and downs can be dizzying, even for seasoned investors. Every day brings a new headline, a fresh wave of optimism or concern, and it can be hard to keep up with the rapid changes. The market's unpredictable swings can leave you feeling excited one moment and anxious the next, as if you're strapped in for a wild ride with no clear end in sight. One day, everything seems to be heading down, causing worry and concern for investors everywhere. You might see people checking their phones with furrowed brows, or hear conversations filled with uncertainty about what tomorrow might bring. The red numbers on the screen can feel overwhelming, and it's natural to wonder if things will get worse before they get better. The very next day, the mood can shift entirely, with numbers climbing back up and bringing a sense of relief. Smiles return, and the atmosphere lightens as investors see their portfolios recover. It's almost as if the market has a mind of its own, swinging between fear and hope and taking everyone along for the ride. These dramatic shifts aren't just numbers. They reflect real emotions, decisions, and reactions from millions of people around the world. News events, economic reports, and even rumors can spark sudden changes, making the market feel unpredictable and alive. This is a common experience in finance, where the market's direction can change in the blink of an eye. It's a reminder that the financial world is always in motion, shaped by countless factors both big and small. Sometimes, all it takes is a single announcement or a shift in global events to send prices soaring or tumbling. Last week was a perfect example, leaving many people wondering what's really driving these rapid changes. Was it a government policy, a surprising earnings report, or something happening overseas? The truth is, the market reacts to a complex web of influences, and understanding them can help you make sense of the chaos. For new investors, these swings can be intimidating, but for those who take the time to learn, each rise and fall is an opportunity to understand the market better. By paying attention to the reasons behind the moves, you can start to see patterns and gain confidence in your decisions. Understanding these movements is key to becoming a more confident investor. It's about learning to separate noise from real news and not letting emotions dictate your choices. The more you know, the less likely you are to panic when the market takes a sudden turn. It's not about magic or guesswork. It's about the information that influences millions of buying and selling decisions every day. From economic data to company announcements, every piece of news can have an impact, and staying informed is your best tool. By the end, you'll have a better grasp of why markets can be so volatile and why it's important not to panic during a downturn. Remember, volatility is a normal part of investing, and with the right knowledge, you can navigate it with greater confidence. Let's connect the dots between the news and the numbers on your screen, so you can ride the market's roller coaster with a little more understanding and a lot less fear. The end of last week was nerve-wracking for investors. As the markets opened on Friday, there was a sense of cautious optimism in the air, but that quickly faded as the day unfolded. Investors, both big and small, watched nervously as the numbers on their screens began to tumble, and the mood outside the stock exchange shifted from hopeful to tense. On Friday, the stock market experienced a significant sell-off, with the S&P 500 falling by 1.6%, its biggest single-day drop in over a month. The red numbers flashing across the digital tickers told the story. Confidence was shaken, and uncertainty was spreading fast. For many, it was a stark reminder of how quickly fortunes can change on Wall Street. This sudden jolt caught many by surprise and created unease. Pedestrians stopped in their tracks to check the latest headlines, and conversations in coffee shops and offices turned to speculation about what might come next. The sense of shock was palpable, as few had anticipated such a sharp downturn. The primary trigger? A disappointing jobs report suggesting the economy might be slowing down. The numbers showed fewer jobs added than expected, raising concerns about the strength of the recovery. For job seekers and employers alike, the report was a sobering signal that challenges still lay ahead. New trade tariffs announced by the government added another layer of uncertainty. The news sparked fresh worries about the impact on global supply chains and the cost of goods, making investors even more cautious. The combination of economic and political factors created a perfect storm of anxiety. Trading volume for the S&P 500 fund SPY soared, showing just how many people were rushing to adjust their positions. Phones buzzed with alerts, and trading floors were abuzz with activity as investors scrambled to react to the rapidly changing landscape. The rush to sell was intense, and it was clear that few wanted to be caught off guard. Heavy selling pressure drove prices down sharply, leaving investors anxious heading into the weekend. The usually bustling cafes near the exchange were quieter than usual, as people digested the day's events and wondered what Monday might bring. The uncertainty weighed heavily on everyone's minds. The combination of a weak economy and new trade tensions painted a gloomy picture for the immediate future. Clouds gathered over Wall Street, both literally and figuratively, as the financial district braced for more volatility. Many wondered if this was just the beginning of a larger downturn. But as we'd soon see, Wall Street had a surprise in store. Sometimes, the market's next move is the one nobody expects, and the coming days would prove just how quickly sentiment can shift. After a weekend of worry, when uncertainty seemed to hang over the city like a thick fog, investors and analysts braced themselves for what Monday might bring. The mood was tense, with many expecting the worst after Friday's sharp decline. All eyes were on the opening bell, and the atmosphere was heavy with anticipation. But as the sun rose over the city, Monday morning brought a dramatic and unexpected shift. The streets, once quiet with apprehension, began to buzz with renewed energy. It was as if the city itself sensed that something different was about to unfold. Instead of continuing Friday's slide, the market surged at the open, Dow up over 300 points, S&P 500 and Nasdaq both climbing. The opening minutes saw a wave of optimism sweep through the financial district, catching many by surprise. As the hours ticked by, those early gains didn't fade, they grew. By midday, the Dow was up nearly 480 points, and the rally showed no signs of slowing. Traders and everyday people alike watched the numbers climb, their moods lifting with each uptick. This wasn't just a small bounce, it was a broad-based rally across many industries. From tech giants to manufacturing firms, nearly every sector joined in the surge, signaling a widespread change in sentiment. So, what caused this sudden and powerful turnaround? The answer lay not in new headlines, but in a fresh perspective on the same information that had caused so much fear just days before. Investors reinterpreted the same news that caused Friday's panic. Over the weekend, conversations shifted, and what once seemed like a threat began to look like an opportunity. The weak jobs report, initially seen as bad news, was now viewed as a reason for the Federal Reserve to step in. Suddenly, the possibility of lower interest rates or new stimulus measures became the focus, changing the narrative entirely. The prospect of Fed action shifted sentiment from fear to opportunity, sparking a rush of buying. Investors who had been on the sidelines jumped back in, eager not to miss out on a potential rebound. This highlights how quickly market sentiment can pivot based on expectations for the future. In just a matter of hours, the mood on Wall Street transformed from anxious to optimistic, all because of a change in perspective. Instead of focusing on economic risks, investors saw a silver lining. The possibility of support from the Fed gave hope that the worst might be avoided, and that better days could be ahead. The market's mood can change in an instant, reminding us that in finance, perception is often just as powerful as reality. One day's fear can become the next day's opportunity, all depending on how the story is told. To understand Monday's rally, we need to talk about the Federal Reserve, the Fed. The Fed influences the economy by raising or lowering interest rates, making borrowing cheaper or more expensive. Just a week earlier, the Fed kept rates steady, disappointing those hoping for a cut. Lower rates make stocks more attractive compared to bonds, encouraging investment. The weak jobs report made investors believe the Fed would soon have to cut rates to support the economy. Suddenly, the expectation of a rate cut grew much stronger. This is a classic case of bad news is good news for Wall Street. The hope for Fed action fueled Monday's buying frenzy. Let's take a closer look at the jobs report that set all this in motion. Released by the Bureau of Labor Statistics, it's one of the most closely watched economic indicators. July's report was unexpectedly weak, even leading to a political shakeup. Initially, investors saw it as a sign of trouble, less spending, lower profits. But over the weekend, focus shifted to how the Fed might respond. The data became the final push for those betting on a rate cut. This bad news is good news phenomenon often confuses new investors, but it's crucial for understanding market behavior. Monday's rally was a textbook example. While indexes tell the big story, individual stocks provide the subplots. On Monday, Tesla's shares rose after news of a massive stock award for Elon Musk, boosting confidence in the company's future. Spotify jumped 4% after announcing price hikes for its premium plans, signaling strong pricing power. Wayfair surged 10% on better-than-expected earnings, while Tyson Foods climbed over 4% after raising its outlook. Not every stock was a winner. ON Semiconductor dropped over 4% on weak guidance, and Figma fell 19% as early investors took profits. These moves show that company-specific news can drive big swings, even on a strong market day. Strong earnings and positive news can lift stocks, while future worries can drag them down. The market rewards performance, not just momentum. Even on a good day, not all stocks rise. Beyond the jobs report and Fed speculation, other factors shaped Monday's market. Trade tariffs remain a major source of volatility, with new U.S. tariffs and ongoing negotiations creating uncertainty. A temporary delay in EU retaliatory tariffs offered a small reprieve, while U.S.-China talks showed some progress. Corporate earnings season added to the mix. Tech giants like Meta and Microsoft posted strong results, lifting sentiment. Companies like Carvana and Robinhood also impressed, but others like Berkshire Hathaway and Hershey warned about tariffs and rising costs. Investors constantly weigh these positive and negative signals. Even strong earnings can be overshadowed by warnings about the future. The market is always balancing hope and caution. Every headline matters. Zooming out, Monday's rebound in the U.S. contrasted with mixed results overseas. Asia-Pacific markets were mostly higher, but Japan's Nikkei fell, showing global markets don't always move together. Gold prices dipped as investors favored stocks, while Treasury yields ticked up, a sign of shifting risk appetite. Historically, August is a tough month for stocks, often marked by volatility. The swings we saw fit this seasonal pattern. Knowing these trends provides context, but doesn't predict the future. Despite Monday's rally, caution remains. Persistent inflation and mixed economic signals keep investors on edge. Optimism about rate cuts could fade if inflation stays high or earnings weaken. The market is balancing excitement for tech growth with broader economic worries. It's a delicate equilibrium. The past week's roller coaster offers key lessons for investors. First, avoid panicked decisions. Those who sold on Friday missed Monday's rebound. Timing the market is nearly impossible. A disciplined, long-term approach works best. Second, understand that bad economic news can sometimes boost stocks if it means Fed support is likely. Diversification is crucial. While the market rose, some stocks fell sharply. Volatility is normal. Sharp ups and downs are part of investing. Focus on long-term goals, stay diversified, and don't react to every headline. That's how you navigate the market's inevitable turbulence.